Good day traders, it's Thursday, September 14th, and this is Alan Ho, market analyst of GKFXPrime. So I'm gonna share my daily analysis through this video, and first of all, let's review the major market movement. So the first instruments we are referring to the dollar index in 4-hourly charts. So the dollar index, which measures the greenback's rank against a trade weight basket of 6 major currencies, it was rose sharply on Wednesdays, up 0.62% to 92.46. was shaking off downbeat economic data showing the wholesale inflation, which undershot the expectations ahead of consumer inflation data due Thursday. According to the Labor Department of United States said on Wednesday, the Producer Price Index for final demand was increased by 0.2% last month after slipping 0.1% in July. In the 12 months through August, the PPI rose 2.4% after rising 1.9% in July. So the weaker than expected wholesale inflation data was failed to dent the rate hike expectations, and as US Treasury yields aided to gain, lifting the demand for the greenback. So the slowdown in inflation is being closely monitored as it could derail the Federal Reserve plan to hike rates at least once more this year. So the Federal Reserve Open Market Committee is slated to meet on September 19 to 20 to review economic and financial conditions and determine the appropriate stance for monetary policies. Ahead of the FOMC meeting, several Federal Reserve members earlier in September urged the central bank to shelve plans for additional rate hikes. Meanwhile, the pound was retreated from one-year highs against the greenback, falling 0.65% to traded around 1.3196 as the latest UK labelled market data showed that the wage growth was remained sluggish ahead of the Bank of England's rate decision due Thursday. Having a tad in commodities markets, the gold price was fell to a third day in a row, was fell by $4.14 or about 0.31% to traded around $1,328.56 a troy ounce. So it was pressured by a sharp rise in the dollar as investors continued to flee safe haven assets amid a decline in geopolitical uncertainty. So the gold price is remained on track to suffer their longest losing streak in more than a month as appetite for safe haven investment continue to fade and underpinning the move higher in both the dollar and treasury yields. So dollar-denominated assets such as gold are sensitive to move in the dollar. A stronger dollar makes gold more expensive for holders for foreign currencies and thus reduce the demand. So some analysts, however, view gold's recent slump as transitory and highlighted that lower prices would attract buyers, supporting a recovery in the precious metals. So according to the Sasso Bank's head of commodity research, Ole Hansen said geopolitical trouble hasn't disappeared and the US political landscape is still fraught with difficulties. When gold dropped almost $40, a lot of investors see that as a good level at which to buy back in. So Hansen's comments come amid data which show net bullish bets on the gold was rose to 245,300 last week, so the highest in nearly 12 months. According to a report from the Commodity Futures Trading Commissions, the CFTC on Friday. As for the oil price, it was settled higher on Wednesday as the bearish data showing US supplies of crude oil rose more than expected was overshadowed by a report from the International Energy Agency estimating global oil demand this year will climb by the most since 2015. So a report from the Energy Information Administration, the EIA, showing crude stockpiles rose more than expected last week, which was threatened to derail earlier gains following a bullish report from the International Energy Agency on oil demand growth. So inventories of US crude rose by roughly 5.9 million barrels in the week ended September 8, and confounding expectations of a rise of about only 3.2 million barrels. It was the second weekly build in crude stockpiles. So crude price recorded their largest one-day gain of the week following data from the OPEC and EIA on Tuesday and Wednesday respectively, pointing to an uptick in global oil demand. So the EIA revised upwards its estimate for demand growth in 2017 by 100,000 barrels a day to 1.6 million barrels per day, or 1.7%. So the bullish outlook for oil demand lifted the expectation that the demand and the supply imbalance in oil market will continue to narrow in the coming months. According to the Paris-based agency, said in its monthly report, the demand growth continues to be stronger than expected, particularly in Europe and the US. So in its monthly oil market report released Tuesday, OPEC said production in August was fell by 79,000 barrels a day to 32.76 million, as falling production from Venezuela, Iraq and the UAE and Saudi Arabia offset the rising output from Nigeria. And now we're gonna review the highlighted economic data that released on yesterday, Wednesday, as well as the focus data and event for today. So yesterday, the United Kingdom was released a series of employment data, including the average earning index and the claimant count change. So both of these data show a negative impact to the Great British Pounds. Okay, so beside of United Kingdom, United States was released the producer price index as the inflation reference data. So the result was at 0.2% growth, which is slightly disappointed when compared to the forecast of economists, which is at 0.3%. So the last data on Wednesday is the crude oil inventories, and it shows a build in the US crude oil stocks with 5.8 million barrels. So as for today, we can focus on the interest rate decision, which will be decided by the Switzerland Central Bank, okay, as well as the Bank of England, okay, during the European trading hours later. So besides that, during the North American trading hours tonight, United States we're going to release the core consumer price index for August, as well as the initial jobless claim. So its technical analysis sessions, and the first instruments referring to the Great British Pounds against the US dollar in 4-hourly charts. So the pair GBP USD remained traded in an uptrend structure, and it was closed above the previous high or the resistance level at 1.32700. But however, it was retraded soon after and currently traded between the both moving edge lines. So referring to the MACD indicator, where the both movement lines were pointing downwards, consider a signal to move slightly lower in short term as retracements. So a closure that's above the recent high at 1.333, suggesting for continuation of its uptrend and probably to move further higher towards the next resistance level at 1.34. The single currency remained traded in an uptrend structure against the US dollar, so referring to the 4-hourly chart, it was actually lost momentum following it failed to close above the previous high or the resistance level of 1.207, and it was formed a double top pattern with the neckline at 1.181. So currently it is traded below the both moving edge lines, referring to the MACD indicator where the both movement lines were expanding downwards. It is suggested to move further lower. So a closure that's below Fibonacci retracement level of 50 or the price at 1.186 will be a signal for shifting trend directions, and it will be suggested to drop further towards the next support level at 1.181, where the neckline of double top pattern. The Kiwi remained traded in a downtrend structure against the US dollar, but it remained traded within a range between 0.723 and 0.73, so a closure that out of the range, suggesting to move further towards the directions of the side if breakout. So the next resistance level we can refer to 0.734 and support level refer to 0.714. So closing below 0.713 will be a signal for continuation of downtrend and probably to drop further towards the next support level at 0.708. The Aussie traded in an uptrend against the US dollars, but it failed to close above the previous high or the resistance level of 0.807. So it was forming a double top pattern with the neckline at 0.78, and currently it is traded near the support level of 0.795. So closing below this level will be a signal to experience a short-term retracement and probably to fall further towards the next support level at 0.788. Looking into safe haven Japanese yen, it is remained traded in a downtrend structure against the US dollar, and it was surged out of the downward channel and currently hovering near the previous high and the Fibonacci retracement level of 50 at the price of 110.9. Alright, so closing above 110.9 will be a signal for shifting trend directions to become uptrend and probably to move further higher towards the next resistance level at 111.7. Otherwise, closure below 110 it will be suggesting to form a double top pattern with the neckline pricing at 107.3, and it will be considered a signal to drop further towards the next support level at 109.1. So gold price is remain traded in an uptrend, and it was retraded from recent high and currently was traded near the support level of $1,321. So the both moving edge line remain expanding upward, suggesting for current uptrend structure. But however, referring to the MACD indicator where the both movement lines were crossed and pointing downward, so gold price is suggested to move further lower in short term as to retracements. So closing below $1,321 will be a signal to drop further towards the next support level at $1,300 a troy ounce. As for the oil price, let's referring to the West Texas Intermediate crude price. It is remain traded in an uptrend structure but currently traded above the both moving edge line and near the previous high or the resistance level of $49.40 a barrel. So this was suggesting for current uptrend structures, and closing above $49.40 will be a signal for continuation of uptrends and probably to move further higher towards the next resistance level at $50 a barrel. That's all for my analysis to date. Please don't forget to subscribe to our YouTube channel by clicking the GKFXPrime logo on the screens in order to follow our updated analysis and education video. Thank you for watching.
GKFX, your global trading partner.